Hive.
Hey, David.
We're here today to make actually a big announcement and also talk about this. This is what we've been working on in the past, very actively in the past 4 or 5 months. Yeah. But then passively, I would say the roots can be traced back to like 2.5 years ago. We will talk about that as well. Yeah. I've been telling you a lot and also to test that in the past few months, it always felt like that, it's not quite ready yet. So you don't want to pull the trigger. You don't want to say that it's there and it's ready. But you do want to have some sort of online presence. And then I always told you that it felt like that we just kept saying, it's something's coming.
Something's coming. Yeah, stay tuned. Stay tuned.
And then there was like an announcement of an announcement as opposed to like an announcement. But what is it?
We're launching a fund.
A what?
Yeah.
A fund?
A fund, yes, finally.
Tell me all about it.
So, over the past months, we've been working on a strategy, on a plan on what to do with Hive and how we kind of want to bring everything together, build the ecosystem, as we like to call it. And we came to the conclusion to launch a fund, which is going to be an evergreen fund and an open-ended fund that is combining stable secondary investment flows with high growth venture building, which is something that we are very passionate about. And then, of course, some liquidity in there as well. It's going to be a unique strategy that's kind of, from what we know, not really present in the current market.
Well, unique can be good and bad, right? You can be unique like you're a fork in a bunch of spoons. You're not fit for purpose. Or you can be unique in a way that we envision it. Mm-hmm. So let's talk a little bit about it. What is an evergreen fund?
So an evergreen fund is a fund that's evergreen. That's forever green. So it's stays open, it's perpetual. Usually venture funds or private equity funds, they have like a timeline of 8, 10, 12 years. And within that time frame, they need to cycle or recycle the investments. Because we're in food and agri and it's a very slow sector, we chose to go long term. We will have like a 5-year lock-in because you still need the capital to be locked in. But we have a long-term view, what means that we can actually pick up opportunities that are not longer interesting for others, but are for us because we can add value in the long term and go from there.
So you traditionally have extremely fast-paced, aggressively growing, sort of like the VC type of funds, venture capital, or you have really like long-term sort of legacy value creation. Let's build something for the decades for, families, family offices, or even asset management, etc. So which category do we belong to? Well, none of it.
None of it. No, we're kind of a hybrid structure. What we see, because we're in food and agriculture, there's been a high growth sector for the past few years, but also companies that are not ready, that have been overvalued, but are good companies where we definitely, with our network, can also add value and build from there. So this is something that is quite unique because usually people need to choose between high growth, which is then the ventures, or more stable secondary funds where they're cash flow, and we will bring the two together. Yeah.
I think it's also important to know that it's a somewhat of an oxymoron that you have an industry that is slow, but it has gone through rapid transformation in the last few years. But I think if anyone has been reading the news, especially about indoor farming and agtech and precision farming, it follows this pattern almost perfectly. For hundreds of years, barely any innovation. Yeah. And then all of a sudden, this sort of almost forced innovation, like we really, really, really need to innovate. And then when it doesn't work, it's almost like crash and burn. So no one tries to really like fix it or patch it up.
Or has the patience. And if there's a lot of pressure to bring value on a short term, then people will maybe also do things differently from if they have a longer run period to build something. So it's the same with those are listed companies like Beyond Meat and what's the other one? That's they massive valuations and now they're valued a lot lower, but it doesn't mean that there's no value in the company. It means that they've been overvalued before, which is a big difference.
Yeah.
So for us, those are also interesting opportunities on the liquid side, on the listed side. So why are we launching a fund now? I think there's timing. It's a very sector-specific fund. It's a very different strategy. And we also do believe that things can be better in the sector.
Well, I would almost go back a bit 2 years before we even talk about now, right? You came to me in 2023 and in the middle of dealing with everything else at the time. And you said, you know what we need? We need a fund. And I'm like, nah, why? What do you want to do with the fund? But it took me 2 years to realize that the network that you have, the network that I have, combine it, and then the new native network that we built together in the past 5 years, if you give that an outlet, if you give that a platform where it can coexist with us and we can work together with our friends, family, and partners, then that needs to be a somewhat open-ended structure. And I'm not referring to the open-ended nature of the fund. No. I mean, it cannot exist with limitations, because in our previous ventures, it was extremely project-oriented. It was extremely target-oriented.
It was very execution-focused and also very depending on third parties on what to do. And I think this is different, where we will get involved on the secondaries, where we will deal with experienced VCs, experienced private equity managers that do have a track record, because we're kind of the new kid on the block. And then you build that leverage from these parties in there, which I think is really interesting, in combination with the venture, what we really love doing, building strategy, being creative, and then have the right people to execute there from the beginning. I think that combination is really interesting also for the why, because then we can be very focused on what we do and where we solve the problem.
Yeah, exactly. And I always felt this sort of like brakes on us. It's almost like the handbrakes were pulled, because certain layers of our network could not be activated because they didn't want to invest in a vertical farm in Amsterdam. Okay, but then they want to invest in India, or they want to invest in Africa, or they want to invest in Brazil. In order to do that, you had to create a project, however small or big or whatever, through which they could invest in there. Whereas now, as long as it fits within the thematic of Hive, which is food and agriculture, but in a broader sense and in a broader supply chain, it's not a problem anymore. So you can effectively attract all of your network into something.
The thing is also, like in the past, we've always spoken about food security, improving food security, and then maybe you got the criticism like, oh, why do you do vertical farming? It's not going to improve the system. But it was like a trigger,
a stepping stone.
A stepping stone, indeed. So we haven't changed the vision from before. We just changed the strategy on how to get there. And I think that's really important.
I would like back to differ, but in a curveball way, that we haven't changed the original vision, but we have deviated from it in the middle. No, not gonna rehash pointing fingers.
It's okay.
Not the point. What I'm saying is that circumstances and certain projects have caused us to sort of deviate from the line, because that's what you do as an entrepreneur, right? You adapt and overcome, adapt, overcome, which we have done. But now that we have this tremendously powerful tool at our hands with insane capitalization, you can look at the entire food and agri supply chain, from production all the way to, packaging, cooling, shipping, alternative proteins, novel foods, etc., and look at it and say, okay, from a macro vision, how can I improve the entire sector and subsectors under it with creating our own ecosystem?
Well, I think it needs a system to improve the system. And we always spoke in the past about vertical integration, but it's one big chain, the food system. Yeah. So it needs to be improved at the different levels of the chain and of the system before you can do anything. And this is why the fund is really interesting, also working with people that have been doing it in the past, but maybe not everything has been tied together. That's why I also think we're different from our point of view.
Absolutely. And if you look at all the sort of voices of authority on this, from United Nations to IPCC reports, to universities, to experts, They all have differing opinions on what is the solution. That's fine. That's fine.
Yeah.
But they all agree on one thing, is that the food system as a whole is broken and it needs a reformation. And that reformation requires capital, but it also requires a macro vision.
And time.
And time. Yeah.
Patience, which is not always there. And I think that's, if you look at the food system, and the biggest problems are really structurally, it's not in the venture side, because that's really like small improvements. But if you look at like cold storage and all of these things, that's really like high impact food system improvements where you need to deploy capital. And I think if we can do that together with other funds, that can be highly profitable as well.
Absolutely. And it also lowers the barrier to entry from our side by lowering the capex by, let's say, half even. Perhaps this is a good time to explain sort of the investment thesis and also the 60-30-10 nature of all of it.
Yeah, the three pillar approach.
The 3-pillar approach.
So we've spoken about investments already for as long as we know each other. And of course, we've always been very passionate about private markets. Of course, you have the public markets. Then we had an idea on maybe doing private markets versus liquid markets, so public markets, which is always a very different approach from what's out there, because it's either one or the other. So looking at that, I think we wanted something stable, cash flow generating, that was
De-risked.
De-risked. That's kind of the backbone of the portfolio, but still very much in the venture side, in food and agriculture, where we can benefit with our open-ended evergreen structure and pick undervalued opportunities that just need more time. Well, it's the same with people, right? Some kids need more time to grow up than others, and that's the same with companies.
But they are sufficiently mature, cash flow positive. They have been existing for a certain period of time, and there is a reason for their existence, and it's not just a quick series A to F cycle and a rock pool. Those companies are not interesting for us. So I think under this category, what should the average person imagine under the 60 category?
Well, it's going to be fund of funds. So we will target venture funds in food agri that we've connected with over the past couple of years. And let's say that's a company where there's an investment 4 or 5 years in. It's in the middle of the traditional VC cycle. And that's where we can pick up, because maybe they already see, or an LP needs liquidity, or they can see this is not gonna mature fast enough within the time frame, and then we can pick it up and they can reallocate capital into new opportunities. So that's going to be really the 60. And over the past 5 years, we've spoken to a lot of food agri funds, of course. So I'm very confident that we will find really good opportunities there.
And I think in terms of geographical and geopolitical targeting, we will probably focus on Europe.
Yeah.
And especially for the 60%, I think we will be focusing on the Benelux countries, Germany, France, Switzerland, Spain, Monaco, Italy. Not Central Eastern Europe yet. No. I think that's going to be the focus of another category, very, very much. And keywords: de-risked, safe, boring, cash flow generating, and professional.
Yeah, that's it. And working with proven companies from the fund side, I mean.
I also think that perhaps at this point it's important to mention that sustainability and green innovation will always be a priority for us, but financial metrics and economic parameters will be the main priority of the fund. And then as a close second, it needs to be also a sustainable green and somehow beneficial.
Sure, but people also invest to make money. And the companies also should make money. If they really want to make a long-lasting impact, then it doesn't help if they never make money, right?
There you go.
So I think that's really interesting on the 60% one. Why we choose the fund of funds and to work with other VCs and private equity firms, mostly VCs, is to build that ecosystem within Hive, where once we build the ventures, the 30%, which is more the long-term growth, we also have these early investors, those companies, to help them move forward and go to the next stage. So you kind of help each other, because if they have like a company that's lagging, we can help and step in and take that over, but they can also support in the opportunities that we provide, because you're in one ecosystem is always like this corny word, but it is also what it is.
It is what it is. And I think it is the best way to call it. I think it's also very important that working with other established funds who are specifically targeting the food and agri sector also de-risks our due diligence process.
Yes.
And it de-risks it from a cost perspective, from a time perspective, but also I would say from our current and future investors from a key man risk perspective, because we can so-called piggyback off of the due diligence of a sector specialist fund, but we can also bring our own opportunities to then have it done externally by that
you
fund.
combine the best, because we're, if I may say so, we're good at spotting opportunities. We have good people around us that can spot opportunities. And that's also on the secondary where we can see this is something that we can work with on the long term. And I think we'll also learn a lot from the funds going forward. Plus, it brings credibility to a newly launched fund as well.
How did you call it this morning? What kind of diversification? Vintage.
Yeah. So vintage diversification is something that I didn't know, but the vintage is the year of the fund. So it's like a 2020 vintage fund, which I thought was pretty cool.
It's really cool. So, okay. What's the second category?
Well, the second category is the venture building. So that's going to be 30% of the allocation, which is still quite a high allocation where you don't need as much, especially in the first year. We won't need as much funding to start with, because how we structure it within the company is that we already built ventures at an early stage with grants and subsidies and some own, how do you call it, like skin in the game.
Vermogen,
yeah, and you bootstrap it almost, and before you bring it to the fund as an opportunity. But that's really where we will look at sports nutrition, we will look at healthy kids food opportunities, and we will also look at other opportunities.
Other opportunities,
more focused on agriculture.
Yeah,
and for that we will work with venture leads, with partners that are really skilled in the early stages of the exploration and the concept phase, so that they can do the execution and we can do the strategy around it and discuss with them.
I got really inspired by this article that you sent me last week about this guy who was also doing a venture building type of setup, and he was launching between 12 to 15 ventures per year, which sounds like a lot. So I think it's an important consideration, and it's an important message to future investors that does not mean that you and I sit on the individual board of every single one of these ventures and it's a personal day-to-day operational job. Mm-hmm. I think it's better explained as a spark, like you give it a spark, and then you have other founders, co-founders, and basically the SPV's own management board that then runs it.
Yep. That's it.
Would you say that's an accurate description?
Yeah, I think to be running like 10 to 15 companies yourself would be a bit hard to manage, I think. So there's also platforms that support in that. So there will be different partners from us.
And I think for the first 3 that we will be doing, we have pretty much identified the co-founders, the target market, the business plan is ready, funding is ready for it. That's something that I think you want to talk about later, sort of the pre-funding opportunities, as well as a clear vision on how the 3 will integrate with one another. And maybe the early iterations of an exit strategy are also on the horizon.
Yeah, that's it. And well, within the fund, we also have a 10% allocation to liquidity, cash. Basically, if there are some listed opportunities like Beyond Meat or others, then we can also allocate to that. But it's important for us to also keep liquidity in the fund. Yeah. That's kind of the strategy and how we work. And I think maybe what we can talk about now is a bit more on how we will build the ventures. We've touched on it a bit briefly.
Just one last thought from my end on the 60-30-10. Is what happens if something is wildly successful and maybe other things are not, how a traditional fund would deal with that and how we deal with it. So what you have in traditional funds sometimes is a forced liquidation of certain assets just because it's like a very narrow mandate, and within that narrow mandate, if it's 65%, they have to liquidate it down to 60, and then that either materializes in reallocation in something else or disbursement to the LPs. We're not gonna do that. So the mandate and the thesis of the fund is such that then we will go far beyond the AUM, and we're going to have the slacking assets catch up to the strong ones and not cut the strong ones down to equalize. So we're going to do an upper equalization and not a downward equalization. Please go on with the
with the ventures, because I think it's really exciting also to talk about it and the whole process of the venture building, where previously we got together and there was already a structure, but really to start from an idea and sit in the room with people and look at, okay, what are opportunities in food, and think about, is it sports, is it kids, is it maybe food for dogs? So all of these things, and then go into that phase together, exploring, is it really an opportunity? I think that's really exciting with the right people. And from there also, kind of build the idea to a concept, and then from there go to the next phase.
Absolutely. I think it's also interesting to talk about, so you have one separation or one layer of separation in the 60-30-10, but then you also have a layer of separation between actively managed portfolio and passively managed portfolio. So I briefly want to talk about that, because we have, you and I, an actively managed portfolio of very interesting target companies.
Yep.
These do not belong to the fund yet. We are using our own money and other shareholders' money to effectively boost the growth of these opportunities. And once they reach a certain level of maturity, then an independent board, where we are present, but we will not be voting on these decisions, will evaluate whether the opportunity is ripe.
It's almost like an internal pre-funded incubator.
Yep.
Where we develop our own companies and pre-fund them, and then offer them to the fund as opportunities, which is quite unique. Yeah.
So what's unique about this, right? You are de-risking it from a financial perspective, because the early stage development is the riskiest. You're basically throwing money on the fire, and then you hope that it doesn't burn the house down. And you are de-risking it from a due diligence perspective.
Yeah.
Because the ventures come into our actively managed portfolio, you can call it our incubator, from incorporation. So there's no skeletons in the closet. There's literally nothing that can go wrong. And if it does eventually go wrong, you just exclude it from the portfolio. It's that simple.
Yeah, you almost pre-build it towards the criteria of the fund. And whilst building it or while vetting an idea, we also have the network of the other VCs and funds where you can touch base with, like, this is what we're thinking. So it's a very interesting, before people invest, you already get like a lot of feedback and you already have a structure.
And because our board at Hive consists of sector specialists, not just in food and agri, but also in finance and business and accounting and whatnot, we have something that we call sort of a validation period, where even before incorporation, incubation, etc., we basically validate the market feasibility of an idea before we even commit, $50K into that something.
That's our risk in the whole venture. So the LP's money is not touched until the case has been validated at a very early stage, which is what you want, because that improves the performance of the fund.
Yep.
And it de-risks the investors.
And even once it's touched, it's only within the confines of the 30%, and the other 70% is effectively shielded from it. And then what I was explaining earlier, should this 30% suddenly explode through an aggressive growth spur, then essentially what you want to do is you bring the others up to level as well, as opposed to selling off what you've gained.
Yep.
Yeah.
I'm really excited to go to market with the fund. I think we expect it to be finalized by the end of April, early May. Yep. So then there will be the official launch. And in the meantime, we will already start going on a roadshow, talking to investors, which I'm very curious to see how the fund and the hybrid structure will fit with them, because I do think there's a big opportunity where normally they have to choose between growth or income, and now they can have the same. So people can, I think, especially family offices, which usually have a longer term, but they want to get into venture, but not with 100%. So they have kind of the brick and mortar 60% with the growth. So I'm really curious to see how we will differentiate from others.
Absolutely.
What I want to talk about as well is why us and why our story is interesting for investors, so for LPs, as they call it. So I think what's important for people to understand is that we're not a generalist fund of funds or generalist VC. First of all, we're very sector specific, food, agriculture, and with a long-term focus. So I think that's something that we've built experience in, and that's very different from us. So with the 60%, we have the lower risk. The 30%, it's more like the venture building, the exciting one. And then the 10% is where we will also work with strong partners. Why we are different is really important also when we talk to LPs, like family offices and asset management companies, because we are not just a traditional VC. We are long term. We're very sector specific and not generalist like others are. So we will have a very stable backbone for people where they have the cash flow, what they need, they have the stability, but they still have the access to the exciting stuff, really, the stuff that you want to talk to people about the golf course. Like, hey, we have this, I'm invested in this fund and they've got this company and they do sports nutrition and healthy snacks and you can show it, and where people are proud of, because they always talk about the small things. Like they don't talk about their 60-70% that they have in bonds. No, they talk about, let's say, Nvidia that they have in the portfolio. So we want to have that portfolio for private markets.
The little buzz, the little excitement, which is also, I think, where most of our physical attention will go to.
I think it's where we work best in this early stage idea creation, but then also have the network, the trust, where people see the spark in the 30%, and they will say, oh yeah, like, oh, David, what he's been talking about, this is gonna be the bomb. But then they also see that 60% of it, yeah, that's with the guys, they've been doing it for 20 years, and I can breathe, I can relax, it's stable. The other 10% that will also be liquid in market, so that's good. But it's really that platform where everything comes together. I think that's where we will really make a difference. And well, you know better than anybody, the food system is really broken and things need to change. So I think we can make impact without selling impact, I think.
Absolutely. And without greenwashing, which has been a huge problem in the industry in the past few years, just to do things, just to say that it's different, or just to, yeah. I think it's also important to note that in this whole ecosystem, we will not be creating some sort of like competing solutions in the first few years. The idea will be to find a good match for every single subsector of the entire food system. Yeah. And then not only via corporate relations, but also practical commercial relations, bind them together. You know, let's have a food production facility in country X, and then let's have a distribution center with the packaging and cold chain, etc., etc. Then let's have shipping. Then let's do marketing for it. Let's do this, and then bind all of that together into one nice chain. And
yeah, and one big portfolio that also supports one another, because maybe an early venture now is in 10 years is a very stable company that could either buy one of the other companies, or if you buy into a food distributor, or if you launch your own food distribution company, then you basically have a basis for all your new other companies to sell into the market. So I think really having this own food system portfolio is going to be very, very interesting, and build on from there, because you don't always have to start big in cold storage. It could be like very small mobile cold storage units where you solve the problem small and then you get large capital in from others. It's starting with the little things, building them together, and then bring on the big boys,
the big guns,
with the big checks.
Absolutely. And then in combination with governmental and institutional help, you can drastically increase also the access to capital.
Yeah.
And then you combine it with a bit of a traditional VC behavior of having venture debt on the target entities themselves. And all of a sudden you have a multiplier of 5x to 10x in deployed capital. And then your NAV, your net asset value, just skyrockets.
Yeah.
Yeah.
I really believe that we have a really good fund strategy to show to LPs, and I think we'll be highly successful. It's going to be now our job to tell that story to investors. I think now we have the episode out, people will see a lot more also on socials, on LinkedIn, where we talk about it.
So I think very important, this is sort of the message I would like to leave with this episode, is that in the coming few months, we will be actively reaching out to our network and our community, and people are welcome to message us directly on LinkedIn, for example, because we will be looking for co-founders and management teams for these opportunities. So I think people can expect such posts also from us, where we're actively looking for a co-founder for a kids healthy snack type of business. And then I would say one of the requirements is that the person has successfully sold a business in that niche or in that subsector.
Yeah, definitely.
Prior.
And also what we will stand for is that we still want to democratize private markets, that we want to make the fund accessible to a lot of people, not just a happy few. So I think that's really also different, and where we want to be a trendsetter, because more people want to make impact. And I think that's maybe something good to end with.
Yeah. So just to sum it up, Hive Fund launch imminent. Yep. 60-30-10. Rewatch the video if you don't know what I'm talking about. Venture building. Active and passively managed portfolio.
Yeah.
And we're starting a roadshow.
That's it.
Thanks for tuning in.
Thanks a lot.
See you.